Hello, everyone, and welcome back to another episode of WAGMI TV. We're back here with episode 19 today. Feeling good. Got a little pump in Bitcoin, and we're feeling ourselves a little bit. It's been a while since we had a nice green daily candle like this. I think we're up like 8% or something today. So spirits are high, and we're hoping for the best here. As always, I'm joined by the absolute fellas. The NFT Lord himself, Alex Garcia, the Doctor, Doc Mata, and the All-American, Ev Smith. How we doing, fellas?
Doing good.
Good. I hope you had a good long weekend.
Yeah, happy 4th. Happy 4th to everyone. Evan got moved into his new crib. How's it treating you, bro?
The 4th wasn't as exciting as I thought it was going to be. We had our movers cancel on Thursday and Friday, so we had to carry 3 couches up 2 flights of stairs. So happy to be back with you boys, because this past 5 days have been a little rough on the back and the legs. But yeah, no, happy to be back. The crib's doing well. Hopefully the Wi-Fi is gonna hold up, but fully moved in and ready to get it going.
There we go. I mean, they don't call him the All-American for nothing.
Yeah, so he's working on that functional strength, is what they call that.
Yeah,
right?
man's knows how to squat.
Yeah, I don't know if the All-American back would hold up that long if I had to do that again, but yeah, we got through it.
All right, sweet. So, obviously some interesting moves in the market kind of happening over the last week. Seems like, it's a little bit tricky. Like some people, from what I've been seeing, we're kind of seeing this push and pull of some people, calling for the bottom to be in. And, we can go into kind of some factors that would point to that potentially being the case. Also, the macro backdrop continues to be very challenging. The Fed kind of stuck in a conundrum with interest rates and trying to, quote unquote, have a soft landing. What are they going to do about that? Are they going to continue to raise rates that could potentially, to the point where it could potentially cause a recession? So a lot of push and pull factors kind of happening in the market right now. What are you guys seeing kind of on your side? What have you guys been seeing this week? What are your thoughts kind of on what's going on from a macro perspective?
Yeah, I mean, I think it really depends on what kind of time frame you're looking at, right? Like if you're looking at over the next 6 to 12 months, I think there's a good chance that we're net bearish. But if you're looking at the next few weeks, maybe looking up to the Fed meeting in late July, I think we definitely have some room to run. But I don't think, if I were to put my money on it, pretty much literally, I wouldn't say that we're quite at the max pain point for equities or for Bitcoin. But that's kind of my take. I think it depends on what time frame you're looking at.
Yeah, that's a good point. I think we saw this week that oil came down from $120 a barrel to 100. So I know there's a lot of talk saying, hey, was that peak inflation? Is a lot of this, fluctuating energy and food kind of come to an end and we're starting to see more stable levels? Like Sia was saying, I don't think so. I think there's a lot of places where we could go wrong in the next couple months. And I think we talked about this in the last episode, that a lot of these inflation numbers are so high because early in last year, the inflation metrics that we saw weren't that high. We were still talking about this 2-3% transitory inflation. And in October, so you said it, that's when it came up to 6%. Like we saw 4% core. So it's really going to be a question of when that October CPI or PCE number comes in. Is that something where we're starting to see levels that are pretty close to what we had 1 year ago, or are we continuing to build on that? And if that's the case, then we're gonna have more problems in the macro perspective.
Yeah, I think it's just kind of a continuation of the saying, right? Don't fight the Fed, right? We say it all the time. People say it all the time, right? I think the market needed a little bit of a relief. One interesting thing that I came across was the fear and greed index. So just looking at it today, right, we're at 20, still in extreme fear, so not necessarily a great position. But in comparison to like what we've seen, kind of in this steady range, what was interesting is we're actually at our highest point from the fear and greed index since, what was this, May, somewhere between May 8th and May 9th. So about 2 months, we're about a 2-month high for the fear and greed index. So people are starting to get a little bit more comfortable. I think that's why we're starting to see a little bit of, part of the reason we're starting to see a little bit of a bump. Like people were exhausted by just all the flush outs, all the liquidations, all the bad bearish news, that it was about time we saw a little bit of a correction here, move to the upside, if you will. And I think that goes right in with Sia's point, right? That if we're kind of looking at the short term, like if you're a trader, you might be able to play some of these swings pretty well, but long term, tons of macro headwinds. It doesn't look super great. We're still got all of our eyes on the Fed, and we can't fight them. So our thoughts are probably long term. It still has a little bit of downturn to go, but looking pretty nice right now. And it's a little bit of a sigh of relief that it just doesn't continue to drop on us, right? I think it helps us just from a mindset to be like, okay, like it's still a real thing. People still take it seriously. So definitely needed.
Yeah, definitely. All really good points. I think one thing that, we always like to monitor is kind of what rates are doing and what kind of the US dollar is doing, given the high correlation, as we've mentioned in the past, with Bitcoin equities and just risk assets in general. So if we go here and we look at the 10-year, so here we got the 1-year chart here. It seems like, let's go to like 6 months or even 3 months. We peaked at around 3.5-ish on the 10-year. And since then, for about, the last couple of weeks, 2-3 weeks, we've had kind of a rally in the bond market. Recently, just yesterday, we actually bumped back up to about the 3% range. But this is, I think, what a lot of people are looking at in terms of what's going on in the rate environment to kind of figure out what the next move for Bitcoin and stuff is, particularly if you think of like algorithmic trading funds and like things like that. I'm sure this is a feature that they're using in their models to kind of predict their buy and sell orders that they're doing. Similarly, on the US dollar index, if it wants to load. We are pretty much at a peak. I think you guys mentioned this. This is all relative to other currencies. So the dollar is still extremely strong on a relative perspective to other currencies. But we did come down slightly from kind of our peak. And so people right now, I think, are kind of weighing the probability that this is going to be kind of like the top when it comes to rates. And when it comes to dollar strength. And so it's really a question of, is that going to be the case? Or are given the fact that the Fed might aggressively like raise rates even more aggressive than what people are pricing in right now, going to push those rates even higher, going to push the dollar even stronger, which obviously would not be good for our risk assets. I think, Evan brought up a really interesting point with what's going on with oil, right? Anytime from a technical perspective, when you see a chart just absolutely mooning, it's really usually not like the best probability to bet that it's going to go up even higher, right? I mean, we saw that last year with the entire market, and we saw that like just now with the oil market as well, right? And so people are also trying to weigh, given the fact that oil is essentially an input in everything, right? And that is one of the primary drivers of this inflation. Is a decrease in oil price going to have an impact on this inflation environment, right? So definitely going to be something to keep an eye on.
Yeah,
I don't know. There's obviously a lot of moving parts. So Ev, what were you going to say?
Jim Cramer called it a buy, dude.
Watch out. Pull your money now.
And that's the top. No, but I think something to also add to that point, Zoe, is for the Fed. We're also seeing quantitative tightening, probably coming up. And that's a like recent tool that's been added to the bag. When we look at the quantitative tightening that happened in 2018, we saw a sharp market downturn from the reaction of that tightening. And so it's a question of, yeah, we might have rates capped at 3% for many reasons. One could be the US government still needs to pay the interest payments on their own loans. And so they might move to quantitative tightening, where they've got, I think it was, is it $9 trillion dollars on their balance sheet of basically mortgage-backed securities, corporate loans that need to be unloaded. And there's a lot of questions right now around how fast that process is going to happen, whether that's all going to happen in the next couple of years here, or if one of that 9 is going to be happening in the next year. So I think there's still a lot of question marks around stuff outside of the interest rate hikes that the Fed can do, more around selling off assets that are on their balance sheet.
It's a great point. I think I saw an article actually this week or last week that was talking about how the Fed said quantitative tightening was going to start in June, but in fact, maybe they did a little bit of it, but not even close to what they had projected in terms of what they had portrayed to the public in terms of what they're going to do. And it shows how precarious of a situation it really is. When you do kind of quote unquote, when the market gets addicted to this drug, it's there's going to be withdrawal symptoms. And so it's pretty tough when you kind of pull that drug away to figure out where the true value of these assets really is. Right.
And that drug was that cheap debt, like the cheap loans that every company, every person was able to get in the last couple of years. It's a question of how do these companies deal with a fiscal policy where it's tougher to borrow money. And I think that's like something we're definitely seeing in the crypto sphere right now.
Well, I think that's something that makes this particular moment in time so unique, is that we haven't had, like, even if we go back to, let's say, like, obviously 70s to the 2000s, then 2000 to 2008, money was never this cheap for this long to borrow. It's like to borrow and use. So you have a lot of pent up leverage, a lot of pent up, funds that have been backed with these really, really cheap loans. And so now it's almost like, where does the buck stop, right? Like what's going to kind of be the last shoe to fall? And I think that's why I'm not necessarily saying this is going to be as bad as 2008, but I think that's why it's going to be worse, in my opinion, than people think, because of how long debt has been so cheap, because we haven't necessarily had this kind of perfect storm of cheap debt for so long, backed with all of kind of what's going on, globally too. So I don't know. It's definitely interesting.
I mean, you talk about a perfect storm and everything's been hit, right? BTC had its worst quarter this last quarter, right? Since Q3 of 2011, right? And then on top of that, it's the worst first half ever in Bitcoin history, right? But not only that, right? Not only that piece, right? It's the worst equity market opening in 50 years, right? So like Sia said, everything is just hitting all at once. The cascading liquidations for the crypto space, inflation, war, recession worries, again, like kind of a unique situation we're in, where everything's just hitting at the same time. So yeah, again, waiting on the Fed and kind of waiting on what that next shoe to drop would be. So
yeah.
When I think keep going, Ev.
Well, I was just going to say, I think on the other side, on maybe a slightly bullish note that you could pull out of all this is that with oil dropping, I think for the second month in a row, we saw mortgage applications drop. Some of these demand side tools that we talked about that the Fed have could be starting to work into different areas of the economy at the moment. And we talked about where supply side inflation is really difficult to fix from a Fed perspective, because they don't have tools for the supply side. So hopefully we can limit demand, and it seems like in some areas it might be helping.
And to the other bullish extent, right? I think we're always tracking the Dixie, right? And like we just saw, so I'm just popped it up there for us, starting to drop out of that all-time high, right? And when typically, right, we've seen when the dollar index is soaring, right? Yeah. BTC risk on assets, they just typically don't perform to the same extent. So not all bearish, but definitely a tough environment that we're basically trying to fight against.
Yeah, and I think it might have been I know that we talked about it on a podcast, but I think Soham said it specifically when we talked about Netflix having that kind of like out of nowhere basically horrible quarter earnings, like first time talking about subscriber loss. I think that was kind of the writing on the wall for consumer spending to start dropping. And I feel like we've kind of seen that in terms of like concerns of like poll numbers too. And so I like to focus on these top three because like once you get below that, it's like more like political, just like not necessarily as relative to the economy.
Right.
But we're seeing, crazy like it's basically like 6 months is what they do. They do these polls every 6 months. But we're just seeing people becoming more and more concerned about inflation, the economy, gas prices. So I think this is also bullish and bearish, right? So to your point, Evan, like I think quantitative tightening is working where like the demand side, people are realizing, okay, I can't be like just spending like crazy all the time. But at the same time, I think we're still going to see some of these small businesses, some of these very consumer driven companies get hit with some of this, kind of reduced consumer spending, over the next 6 months or so. But I think it's a great point to say like, I think we expect since like the market and like what Fed Powell or what the chair Powell is saying, like everything is going to be like instantaneous. But I think it's probably like Soham probably knows this best, but maybe like even like a 2-quarter lag from when the rates get raised to when we actually see an economic impact. So I think, to your bullish point, I think we'll probably start seeing some of the positive impacts of the quantitative tightening pretty soon.
Yeah. And it turns out the first thing that goes is people's Netflix subscriptions. Now we know.
Well, and I think I could be wrong, but I'm pretty sure the used car market kind of fell off a cliff recently too, like relatively speaking, because it was so high. But
yeah, so I know I know I posted that in our chat. Damn, got something in my throat. I know I posted something in our chat probably a couple months ago where it seemed like it had peaked. I haven't tracked it since, so that'd be interesting to circle back on to see what that looks like.
Yeah, I remember when we talked about some of the core inflation numbers that we had a couple months ago. Used cars were around, I think, 1 to 1.5% in there. It would be really interested in this next CPI that's coming up to see how much that's playing a part.
Yeah, I think this is just a thought that I'm almost having on the fly here. But when we were in 2020, the crazy thing that the Fed did was almost because of the quantitative easing and the low interest rates and all of this stuff, they almost perpetuated a cycle of bad news equaling good news for the market, which historically has not really been the case, right? Like historically, economic advancement, economic growth, things of this nature have been positive for the markets, right? Versus everyone just getting free money and like lower interest rates, and like a recession and like bad news for the economy has not translated into good news for the markets, right? And so we're almost seeing like this weird dynamic play out where the market wants to kind of figure out where to go right here, where it's like we're almost taking bad news as being good news still, right? Like it almost feels like that in a way, right?
Because it's like as projected, right?
Mm-hmm,
like when it's like, oh, we're expecting a 50 basis point rate hike. So then when it comes, everyone's like, okay, that's good news, right? Even though it's still kind of bad news, right? Just because it was expected and didn't hit the market, take the market off track.
I'm saying even more like economic indicators right now that you would historically have been like, that's not a great sign, is actually perpetuating risk on attitudes because people are looking ahead and being like, oh, the Fed is going to have to do something about this. like that whole idea of like the Fed put is still in people's mind, right?
And
so
that's a great point. And
when you
go
see
ahead,
like
sorry.
oil prices crashing and like things like that, like historically, it's actually pointed to, oh, like there's a decrease in demand and like maybe a decrease in, you know, global growth and like things like that. Obviously, we were working off a ridiculously high base, so it had to come down at some point. But historically, that's actually been more of like a quote unquote recession indicator. Now we have markets rallying and like, you know, crypto rallying, and we're getting little bounces based on quote unquote recession indicators, because people are looking ahead and being like, oh, if there's a recession, the Fed is going to have to back off the rate hikes, right? So it's like, going back to 2020, I've said this before to you guys, but the Fed just boxed itself into a corner where it just has like really no way out without just screwing something up. And that's kind of, you know, where we sit today. It's very interesting. And
that's a great point, and I think it aligns really well with something Evan had sent in the chat earlier, right? Jobless claims. If you want to pull that up, Ev.
Yeah.
Another reason, right? We're seeing kind of a bump there. If you want to go into that, but I think that aligns really well. Like, it's not necessarily good news, but everyone's kind of predicting, right? The market acts first, and they start to try to predict things that are going to have to come down the line based on some of these news pieces that are coming out.
Mm-hmm.
Yeah, I think something that, you know, like Mata's saying, should be highlighted in this article was basically that the unemployment benefits rose to a 6-month high, right on this sentence here, a sign that growth in the labor market is slowing down. And that's whenever we hear Chair Powell talk about, you know, the 50 or 75 basis point hike that they came out with the month before that, there's always key indicators of why they feel like they can make those hikes. One of them has always been a strong labor market, low unemployment. And that's really been a key driver, at least, you know, one that they've portrayed to the listeners of those press conferences, that they can continue to raise as long as those factors are low in strong metrics. And so, you know, this was an article that came out today, and it basically was saying that we might have started to see that strong labor market, you know, weaken a little bit, and this could potentially be another reason why, you know, we might not have that 70 basis point hike that has been on the table. Maybe we'll have a 50 continue months on the line. Who knows if it'll play an even more significant factor in the rates that happen down the line.
Yeah, no, that's interesting. I can pull up, you know, something for us to keep an eye on from the macroeconomic calendar standpoint. Just looking ahead to kind of the next week, and, you know, front and center, you guys already know what it is.
FOMC.
Front and center next week, Wednesday, CPI prints in the morning. And so, you know, this is what everyone's going to be looking at. Year over year expectation is, or the previous is 8.6. Forecast hasn't been put in yet, so we don't know what the expectation is, but I'm assuming it'll be about the same. Going back to kind of what we talked about last week, like that base effect, right? 1 year ago, I believe the CPI number was still in like the 5s, right? And it wasn't until October, like Evan mentioned, that we started creeping up into the 6s. And then after that, it was just, you know, 7s, 8s. And like now we're, you know, here now, right? And so it's going to be really, like, obviously everyone's keeping an eye on this. I think the next few prints, I don't see how it could possibly come down unless some of those, you know, inputs within their calculation miraculously like drop significantly. So I would expect another like 8-ish print for the next few months. But October is really going to be where we look at that and say, okay, if we're still going at 8% now with the base effect, with the base rising, that's a real problem. So let's kind of see. Obviously, Wednesday is going to be big for the market in general. It's going to be all eyes there. If we look ahead, We have jobless claims again on Thursday. So honestly, next week is actually going to be pretty telling. And then, consumer sentiment, which is currently like, I think the lowest it's been in like 40 or 50 years, like something absurd. And retail sales. So a few, definitely, CPI takes the cake next week, but definitely a few other economic indicators to keep our eyes on next week. I don't know if you guys have anything to say on this piece.
See, I think you might be muted, but something that I was going to say is that it'll be interesting to see the gap between core and non-core CPI. I know we've seen oil come down, and I haven't really kept up with food, but there's been a significant, usually 2% gap there, and we'll see if the recent drop in oil might play a difference and drop that 2%.
Can you just remind us again what the difference between core and non-core is again?
Core is all items that don't include food and energy. Food and energy are two, pieces of inflation that fluctuate a lot. So they're not included in core. I think I cut you off though, Sia. What were you gonna say?
No, I was gonna say it seems like Powell, I guess, like, and he's alluded to this in some of his previous conversations, and in some of these, speeches, but it feels like we're basically testing and kind of trying to delineate how much of the inflation is supply side and how much of it is demand side. So essentially, he's going to try to push those rates as far as he can to try to understand, okay, how much can we control from a demand side? If we can't control from a demand side, it's going to turn into, okay, now we have to talk about economic policy. Now we have to talk about, maybe discussing with the Senate, and talking about working with, allies and trying to figure out, whether it's oil or whether it's, baby formula, or whether it's, a lot of these products that are in shortage, how do we kind of peel back the supply side inflation? So I think right now the goal is to decide, like, where's the barrier for demand side, and then can we address supply side with our allies and whoever else we're working with to kind of supply our population and other countries' populations.
Yeah, I think that's a great point. I think that's something that, hopefully we're not going to have to see until later on this year, when we really have big answers on inflation and some of the other like key metrics that are really coming up, based on the year over year metrics that we're talking about. We're not getting answers on this stuff till, like you're saying, a couple quarters down the line. So yeah, exactly. That's something that you can see how that ends up turning out.
Yeah, and I think before I know we want to go into some DeFi stuff, but just to give people kind of an idea, I marked the Fed meeting on this BTC chart. So like you can clearly see we still have some time. So like I think Mata was saying this, and he had kind of read up on this a little bit, but that maybe
I lost Sia there.
Maybe we get somewhat of movement to the upside. Oh, did I freeze up there? Sorry, squad. Some Wi-Fi issues. You got me now?
Yeah, we got you.
We got you now.
Okay. Sorry about that.
Yeah, you were talking, I think, about the 200 week, and then we were talking about the Fed meeting and approaching that, what it might look like. I think that's where we lost you.
So real quick, like this white line on the graph is the Fed meeting. So like I think Mato was talking about this earlier. To his point, like we still have some time to stay bullish before we might come back down. And I think the area I'm watching is this kind of purple zone. So this is between 17K, 17.8, where we had our lowest tick, and then 12.5K, which 12.5K is a very, very key resistance that we had previous about a year and a half ago. And then it also marks the so very important level for us to be watching. But I know I'm getting a little freezy with the screen share, so I'll wrap this up here.
No, that's super helpful. It's always fun to look at the TA, right? It's like everyone's always like, this time's different, right? But it's never really that different. And so if we can find little correlations like that, it's helpful to kind of guide where we're going and what this could look like. It was interesting looking at that chart where it's like almost the perfect amount of time for Bitcoin to shoot up and then not be able to retest that 200-week moving average to then bump back up, which is what we want to see to kind of stay bullish, if I'm correct, right?
Yeah.
We'd want to see it push up through that 200-week moving average, then come back down and shoot right back up when it hits that line. It seems like it's going to be like a perfect storm where it's going to go right up into the Fed meeting, and then Fed meeting is going to happen and we might see a little bit of a tank there. So kind of interesting, something to keep an eye on there.
I mean, I'm wondering what's going to happen if we're right around that point, the 200 a week, and we get a 50 bip hike instead of 75.
So the expectation is 75 right now, right? I'm assuming, since that's what we did. Yeah. That could be really interesting. I mean, I think to Mato's point, we could see, 28, 29K. I think the next, and just for the sake of my Wi-Fi, just so we don't disrupt it, but I think the next, like I'm seeing the next Fibonacci level is 30K. So if we were to go above 30K and stand on top of that, we could channel range between 37 and 30K, pretty much no problem. Now, whether that stays as the bottom, I don't know, like, if things get worse macro, but for a while we could range between 30 and 37, which would be interesting.
Well, so we've seen last month where literally on a Thursday, there was a CPI print. And on that next, like, what was it, Tuesday or something?
Yeah.
They raised 75 because of that huge CPI print on that Thursday, right? So we know they're watching the CPI very, very closely. And we know it's also 1 week ahead, right? It's on the 13th and the meeting is on, I guess, like a week and a half ahead of the Fed meeting. So we know all eyes are going to be on that. If we get another print in the 8s and stuff, like, I think it's pretty fair assumption that they're going to hike 75. If we do see it like kind of tapering off though, which I don't personally think is going to happen, but if we do, look out for that 50 bip and then maybe we're off to the races.
Yeah. And that said, with the FOMC, what do they call it? The FOMC minutes, right? I think what everyone kind of took from that was that they took the 100 basis point hike off the table. Is that correct? And that's why everyone was like, oh, okay, we predict 75 and they've taken 100 off. So at the worst, it can be 75. Was that the idea? Is that why we saw a little bit of a rally? Or did I interpret that wrong?
Yeah, I think there could have been a couple reasons for that. I know, like Zoe mentioned, the US dollar hit the peak, like its peak strength. And so just on the downturn that it had recently, that could be a reason why stuff shot up. I mean, it's never a bearish signal for them to go from 100 basis to 75, I could even see 50 being on the table if we saw a terrible inflation number come out here. So yeah, I mean, it's great to hear they're not doing 100 basis points. I think that would turn the market into cardiac arrest, but
that said, right, these minutes, right, the minutes are old, right? They were from a couple weeks back. I think it was like June 14th. So it's like, what has happened since that, right? We've had nonstop recession talk. You see it everywhere we go, right? Consumer demand's crashed, oil prices are tanking, right? All these things we've been talking about. So it's like, yeah, they took it off the table then, but you never know, right? I think they're watching it just as closely as we are. And I think Powell even admitted, like, he's like, I don't really know what's going on. So we're going to see what happens and make a decision from there.
Yeah. When was our first rate hike? Do you guys remember what month they first hiked it? I
believe it was March.
So I would say, like, just in the last, like, in watching the housing market, just in the last like few weeks, we've started to see a serious like slowdown. And like, so I mean, maybe that's an indication of like, okay, maybe it does take like 3 months, 6 months to actually get kind of some impact on, the assets that we're targeting. But I feel like the housing market has just started to really feel it in terms of like houses staying up in the market. Then I'm seeing 10K off, 20K off, 30K off, where, homes were going in 5 days, no problem in most markets. And now, you're seeing a lot more inventory come on the market as opposed to what we were seeing before. So it seems like that's one of those asset classes that's finally starting to feel it. And I feel like that goes to the point that you guys have been making about this kind of delayed reaction to these rates.
Right. And I don't think it's something where they want to like it's coming into the area where they don't want to tighten too quickly. There's the question of, are you just putting this economy in a chokehold? You got to allow it to run a little bit, and whether it stalls or it just slows, that's the biggest question. And you want it to slow, you don't want it to stall. And so it's like Mata said, 100 basis point is probably off the table. I wouldn't be surprised if we even drop to 50 basis point if we start to see even more, headwinds with some of or you see the market and the economy slowing too much. So,
yeah.
Well, I think talking about,
I was gonna say, I know we were gonna talk about, more cryptoverse stuff. So, but right before we hop into the DeFi, I wanted to give us a little bit of an update on the flow charts that we were looking at by James Butterfield last week. And so on the left here, you have volume 86 for the digital assets that we covered last week. And then on the right, we have this most updated piece for this week. So as you recall, last week was a super massive outflow, specifically out of Bitcoin, which we hadn't seen in a long time. The month-to-date flows were bad, and then the year-to-date flows were almost put back down significantly, right? So pretty big outflow there.
Mm-hmm.
In a comparison, we saw a little bit more of an inflow. Bitcoin's just slightly positive here. We saw more into Ethereum. What's interesting, and something that we called out last week, right? We saw this massive outflow out of Bitcoin, but we didn't see a massive inflow into short of Bitcoin. I want to draw your eyes here to the short Bitcoin now, which has increased pretty significantly. And so I thought that was pretty interesting to see that come about after we kind of talked about it last week.
And wait, what
I don't know if you guys
are these institutional investors or just like net for everyone, or?
Yeah, as a recap, this is all institutional investors. So you can see kind of the biggest up here with Grayscale, CoinShares, Purpose, all of these, right?
That's right.
Those are the main ones they're tracking. So this is all institutional buying.
Interesting. And when was this put out?
This volume 87 was July 4th, and 86 was June 27th.
Wow. That is actually really interesting.
Yeah, because if you're
shorts went up significantly then.
Yeah. And I'm wondering if they're saying, well, hey, like there are better assets, like in terms of the timing, there's other assets we can put our funds into in terms of equities that we see that are really, really, hit to the downside. And then maybe we come back to Bitcoin. Like, I don't really know exactly what the logic is, but this tells me that at least they think there's some more downside to come towards the crypto market. And obviously we're seeing a huge divestment from Ethereum, and maybe that's due to the uncertainty there, but not quite sure.
Yeah. I mean, it's a crazy difference in the week flows. I mean, that's 400 million to not even it makes me think immediately to the domino effect that we've been seeing from different lending firms in the crypto space. And I think it's a question that probably all of us and we've been hearing on Twitter or whatever is there a larger domino to fall? It's almost like we're in this waiting period where we're trying to figure out how far has this epidemic of bad loans stretched? What other players could this affect? And so I think it'll be a different, a very different chart we'll see next week, just based off the pop that we had today in the last couple days of green. But it's kind of a nice little look at the weekend review of how confident people were in investing or putting money anywhere last week when we had so many different failures, institutional failures in the crypto sphere.
Yeah, and something I also kind of took from this is, I mean, again, this is all institutions. We look at Solana, I mean, still year to date, they're pretty strong. Like they're the strongest other than this multi-asset category, right? It's just like institutions still really love Solana. So I don't know what that says, right? We see a huge outflow of Bitcoin, and then all of a sudden Bitcoin starts spiking again this week. Who knows what's going on here? But I think it just kind of goes to show people are not comfortable, and no one really knows where this is going, including the institutions, and they're trying to remove themselves from as much risk as possible. To kind of go a little bit deeper into this, and I won't labor on this too much, but I thought this was an interesting chart for the week numbers for 2021 to 2022. Obviously, we saw this massive inflow many weeks back, and then we saw the biggest inflow or outflow we've seen last week. It does appear that we've seen a slight inflow again here this week. So again, we'll keep track on this. I think it's pretty important just to understand how institutions look at it and how they're feeling about it as well. But yeah, just thought of some interesting stuff to share.
That is interesting because it also last week lines up perfectly with Garcia's analysis last week, which was like the, inflows to exchanges and stuff like that, right? Sia, you had pulled that up last week, right? So that almost lines up perfectly.
Yeah.
It's like, on chain to exchange inflows seemingly directly translated to just a ton of outflows out of the asset class entirely.
Yeah, it's interesting because crypto is one of those assets. It's not like, equities where your money is always ready to be exchanged and traded for USD. Crypto, 9 times out of 10, anyone that's holding, experienced investors that are holding for longer than a few months are going to transfer it elsewhere, whether it's a MetaMask or whether it's a Ledger. And so these big guys that are holding this money, it's really, really easy to track when they want to sell because they do not hold their stuff on exchanges. And so when you see all of a sudden, oh, wow, exchange holdings week over week are up, 100%, 200%, 9 times out of 10, it means that someone's ready to sell or a few big players are ready to sell. So that's a really good call out, Zoe. Yeah.
Interesting. Yeah, we'll have to keep an eye on that going forward, at least have a pulse on it, maybe every couple of weeks or something. That'd be cool. Cool. You guys want to dig into the DeFi Voyager drama that we saw?
I think so. Let's do a little deep dive into the whirlwind that is Voyager. So I think we mentioned it in a previous episode, maybe last episode. But essentially Voyager is just a crypto lending service. They've got some fun products like a debit card where you can earn loyalty points, and I think they have some other interesting, gimmicks that you can have. But essentially what they do is, you're sending your money to them and they're able to create great rewards for the crypto that you deposit in. It's really a black box into how they get those rewards. There's not a lot of insight into who they're lending to, or what different protocols they're using to gain rewards. But Voyager last year was one of the top 10 most downloaded apps on the iPhone App Store. I think in the month of, it was either June or July. So it's extremely popular. And so it had this awesome, last couple of years. I think it was founded in 2017, 2018, and 2021 was really a huge year for it. And a lot of the, they started to see a lot of deposits on their platform where they needed to continue to create these impressive yields for their customers that have lended. And so what they do is, they're able to take this crypto that people have deposited to them and send it out to other funds like a Three Arrow Capital, like an Alameda Capital, which was founded by SBF, founder of FTX. And they're able to do whatever they want. And as long as they're repaying these loans, then there's no problem. And the customers that deposited on their platform are getting these very nice returns. The problem, and kind of why we're talking about it, is that these loans need to be repaid. And when they're not repaid, there's serious repercussions. And, when we look at Three Arrow Capital, I think we mentioned it last week, they took a $660 million loan out from Voyager, an unsecured loan, basically meaning they had to put nothing up in collateral. They were just given $660 million. And then Three Arrows Capital did the same with BlockFi, but it was a little bit of a collateralized loan where they were given Bitcoin. So you see both of them, yeah, in this chart here. And so, you know, Three Arrows went in and they bought a ton of Bitcoin and deposited it to borrow against stable coins. And some of these stable coins, or one of the stable coins, were Terra. So essentially there was this, it was in March 2022 when this loan went out to Three Arrow Capital. They lended 15,250 Bitcoins, probably an egregious number when you add in the market value of Bitcoin at the moment, and then also 350 million US dollars. And so the loan was callable at any time. Basically, Voyager could go in, talk to Three Arrows and say, hey, we need this money back. But after the Luna crash, you know, Three Arrows stopped responding to them. And that's, you know, probably the understanding that you know, Terra lost 99 to 100% of its value. And you know, they no longer had any money to be able to send back to them. So in the last week, Voyager has gone and filed for Chapter 11 bankruptcy, which is refiling or restructuring. And so that was something where the process that they took for this was that they hired a couple firms to see if any traditional finance like Goldman Sachs, JP Morgan wanted to acquire them. They went through and found that nobody wanted to do it outside of court. There were a couple people interested, couple firms interested in acquiring them in court. And that's when FTX hopped in. And so the interesting relationship here is that FTX, founded by Sam Bankman-Fried, he's also the founder of Alameda Research, which had $375 million worth of loans taken out from Voyager. And so last week we saw FTX come in and give Voyager, I believe, a $250 million loan. And so basically Sam Bankman-Fried was able to come in and buy out Voyager with the money that he already had to pay to Voyager. Pretty nice deal on his end. So yeah, at the end of the day, Voyager had enough funds where they were able to be bought out by FTX. But when you look at some of the other firms like Celsius, that it's estimated that they have a hole of $2 billion that needs to be repaid. You know, that's too big of a problem for companies like FTX or Binance or some of the other firms that are coming in and buying some of these insolvent companies to be able to, it's too big of a risk for them to take on. So yeah, that's kind of the rundown on Voyager. They declared bankruptcy, but it sounds like they're going to be bought out by FTX and just going to be absorbed.
No, that
is fucking wild, dude. Like, that is just the type of stuff that just makes you not even appreciate, but just it's crazy how interconnected everything is, right? And you know, I see a lot of people on Twitter being like, oh, this company took a bailout, this company took a bailout. And that frustrates me a little bit because that's actually not a bailout. This is actually like your company completely failed and you're getting like scooped up for pennies on the dollar. That is not a bailout. That's just like the free market operating how it should operate. And not to bring this back to the Fed or anything, but this is like the key thing that the Fed has ruined within our entire like economic system, is this dynamic of the free market economy. It's like these entities in the crypto sphere took out outsized risk, did not manage their risk correctly, and are paying the price for it. They're not getting bailed out. They're totally failed companies. They're getting scooped up for pennies on the dollar. When you see FTX come in and buy these companies, they're not bailing them out. They're literally just like buying their assets and anything they have for nothing, right? And you see the inherent, you know, motivational bias and like the weird dynamics that it plays in the market when the government steps in and starts creating liquidity for assets that have no liquidity, right? Like the reason why the price for BlockFi went from 5 billion valuation to 25 million valuation is because there were no buyers, right? When they were doing great, there were buyers at 3 million, 4 billion, or 3 billion, 4 billion, 5 billion. All of a sudden, they didn't manage their books correctly. There's no buyer at 4 billion. There's no buyer at 1 billion. There's no buyer at 100 million. There's finally a buyer at 25 million, right? And that's how the free market decides what happens, right? When you have the Federal Reserve come in and on these assets that are worth pretty much nothing, come in and create a market and offer a buying price way higher than what they're actually valued at, all of a sudden you run into this crazy moral dilemma of like, what is the role of this government entity in the first place, right? And so I don't know. I like, there's a lot of stuff happening in the crypto market that's negative, but I do see a positive in this, in that like, there's nobody coming to bail these people out. And that's part of the reason why it's interesting to keep track of this space, because we know that the ones that do survive all this accurately manage their risk and are going to be good going forward, right? I know that was a little bit of a spree, but it just, you know, kind of ticked a nerve that I've got for a while.
No, I think that's perfect. And I think it also alludes to, and I mean, correct me if I'm wrong, we were talking a couple weeks back about 08 and the banks having to kind of restructure how that looks and regulations going around it because of how bad it was and how risk was not managed correctly, right? I think that's very similar to what we're seeing now in this market, right? It's just kind of like a little couple steps behind. It's, I think we always say it, right? It's the Wild West. And I'm going to share this piece, right? Some of these organizations, right, they either suspended withdrawals or they have liquidity issues, right? And I think this whole ordeal, the Solend stuff with Solana, right? It's like, it really it's serving as like a wake up call to the crypto community and thinking that we always have control and we can just put our, you know, our money in these companies and they'll be able to essentially do really well with it, right? Whenever we're connected to some sort of decentralized area, we're essentially giving them permission to do what they want with that capital that we've given them, right? And so now more than ever, it's one of those things where it's like, not your keys, not your crypto. Make sure that you truly own that. It's not sitting on an exchange. It's not sitting on one of these platforms, right? Just be careful out there because there's a lot going on, and you know, we're still very, very immature in this space as we move forward. So it's my last little step off my soapbox there.
Well,
No, that's a great flag, Mata. That's a great flag for sure.
Keep going up.
And I was just going to say it. I mean, we've talked about it before, but ownership is the biggest thing. You want to be able to own your money into, and that's something that is even more important. And you're seeing bank runs on these crypto banks and not being able to withdrawal limits. I think Voyager took their withdrawal limit from 25,000 down to 10,000. And we saw that on the Celsius side as well. So you got to own your assets. And it's interesting because crypto allows you to do this. This is not something that you could do at a JP Morgan Chase bank, is, you know, really have your money, even if it's in a bank account. I guess you could pull out and you know, that would work, but yeah, it's more important than ever to own your assets.
I think the other thing to zooming out is, you know, what kind of message does this send for the next big crypto companies that are in development right now, right? It's like, oh shit, we can't just take out crazy leverage and like promise all these wild things to our stablecoin holders and then turn around and go leverage our capital that we get from them and then be exposed to this crazy risky downside. So I think it sets this kind of tone of like, hey, we actually, you know, we can't just go into it totally gung ho. We have to have a very, very planned out risk off and on strategy. We can't just like assume that we're always going to be in kind of a bull market and people won't want to pull their cash out. And the other thing too is like going back to, I think both Ev and Soham said this about how we're kind of thinking there could be another big player to fall. Like if we look at, I think the chart that Evan showed said that there was like 1.1 billion outstanding loans. Like if we think about what that is in the total market cap of cryptocurrency, it's like 1.1% of the entire crypto market cap. So like if we zoom out, like Celsius, Voyager, BlockFi, all these people could go underwater and it's really not going to even matter like in the long term. So I think thinking about how much of that consists of the market cap of crypto is also important. But yeah, no, I think it's definitely just something to consider.
No doubt. No doubt. All right, boys. Well, I think that might do it for this week's episode 19 in the books. As always, to the listeners, thank you so much. If you found any of this useful or entertaining or anything, make sure to like, comment, and subscribe down below. And yeah, we'll be back next week. Keep an eye out for that CPI print. We definitely will be. And same time, same place. You know how it goes. WAGMI.
Later, guys.
Later, boys.